I always tease that it was like the earliest days were the island of misfits, right? We got all these weird kind of loans, everyone that couldn't do something. And so we differentiated on, hey, we can match your weird loan real well. And there was just such an organic demand because there wasn't another solution. So we were displacing things like Excel.
Hello, this is Shawn Budde of Ensemble X, and this is the Ensemble X Exchange podcast. Today I'm talking with Rhett Roberts of LoanPro. Rhett is the co-founder and CEO of LoanPro. As a serial entrepreneur with a Bachelor of Science in Investment Finance, he has a deep understanding of needs for fintechs, banks, credit unions, and any lender or credit provider. With over 20 years of experience in financial services, building LoanPro has been the primary professional passion of his life. Since founding the company with his brothers, the platform is trusted by over 600 customers, including Best Egg, SoFi, Intuit, and others. Rhett also serves as a board member of the FinTech Committee at the University of Utah. Thanks for joining me today, Rhett.
Shawn, thanks for having me. Excited for the conversation.
So am I. So before we jump in, though, let's talk about you jumping into the water. That was painful, but it'll work, I suppose. I hear you're an avid swimmer. Why don't you tell me what avid means in this case?
Oh, everybody likes to pick different sports. I used to be really good at it growing up and did quite a few competitions. And actually, one of my goals this year is to swim cumulatively 250 miles. I'll do a few different races, but most mornings I'm in the pool swimming, and I love that as exercise and thinking time and a good exercise to do.
Yeah, I have to say it bores the heck out of me, but I suppose it could be kind of a meditation process.
Yeah, it's very much like trail running, right? Where you sort of like get to think about it and get into this cadence, and it's one of my favorite thinking times.
That's awesome. And in college you swam then?
I didn't swim for university, but I did all growing up, and then decided to start a couple different businesses during the university years.
Okay.
And so I didn't swim, but times and stuff, I could have made several teams here for swimming as well.
Got it. And I understand you've done Escape from Alcatraz.
Yeah, I've done a number of races around the country. One of my favorites is there's several races a year in San Francisco, and there's multiple organizations that put them on, but a few of them are Escape from Alcatraz. You go out on a little tugboat, drop you off. You got to swim back. It's got some pretty good currents, pretty cold water. I've done that a number of times.
Yeah, so I have some friends who've done it, and the big question, I guess, is always wetsuit or no.
Done it both ways. It's pretty cold water, so I've done both.
I can't even fathom it. All right, so let's jump in. And before we really get started, can you just kind of give us a view of what is it that LoanPro does? Where do you guys fit into the ecosystem?
Yeah, awesome. So we provide software to lenders of any kind. So as a consumer, if you think of you log in online to see your bank account or to manage a loan, what's the system behind everything on the loans? Or if you walked physically into a branch and have questions about your account or called in or whatever, what is the system that the employee who's helping you is pulling up your loan to engage to, make a payment, change a due date, to manage the compliance? We do the system of record, basically 3 different kinds of customers. Our first is private credit. These are non-depositories that give loans of variety of shapes and sizes. Second is a financial institution, banks and credit unions. And third is credit card issuers. And we're the back office, the platform to manage all of the servicing, collections, compliance, and so forth to do loan administration.
Got it. And how is it that you got into this space? Like, what were you initially trying to solve or focus on?
Yeah, that's a story. That's
okay.
So I did my education in investment finance, went back onto Wall Street, decided not to take a job back there out of university, and instead joined my 2 brothers. And we wanted to do the entrepreneur route roughly about the time that I got married. And we thought, you know what, let's go ahead. We don't have any money, don't have any real responsibilities of things to pay for yet. And we thought it'd be a good time to start a business. Did a few things as a kid growing up, a few different, we'll call them jobs, but different business ideas that we tried. And so I started our first business with my brothers is we invented a bridge that you can suction cup to a windshield, inject resin into the layers of a windshield to cure a rock chip.
Okay.
And that would fix a rock chip so that it prevented from cracking out the windshield. And then we built software to submit the claims to the insurance companies. And that was really our first foray or experience with software. As watching your face there, you're like, I was not expecting that.
You are correct.
So that was the first piece. We built that out, franchised, sold that business. We started a car dealership, had a few different dealerships over the years, service centers and things, learned we could sell a lot more cars if we could help our customers get financed. This is, roughly 20 years ago. And at that time, the market for financing, customers would come in and buy a car. You'd either pay cash or you get a loan. And on the loan side of things, there was like prime and subprime with kind of no gradient in between. It was like, go get a credit union loan, super low interest, or it was subprime. And we just kind of scratched our head on that and said, that doesn't make all the sense. There should be some kind of gradient steps in between. So long story short, we started financing customers that we acquired the loans through our own dealerships, and we fell in love with lending. We just scaled the lending business, sourcing loans from our own dealers and then from others, built a nice portfolio of auto loans. And it was a great complement to a retail sales business. The volatility, the predictability, it was sort of offset with that on the loan side, the back office business. And as we scaled our own portfolio of loans, we ran into a new complication that the software to manage that portfolio of loans, let's just say it left a lot to be desired. It was pretty frustrating to use. Customers would call in and they would need what we felt like was normal servicing experiences. They needed to change a due date, or their payroll cycles changed, or they needed to fix the car, or whatever, like these normal life events.
Yep.
And there wasn't a button for that in the software that we were using at the time. And so having a little bit of background in the software space from the earlier businesses, we decided, hey, let's go see what all the big players do. Did a research project, and we learned that most of them just build a orchestration layer to stitch together a bunch of different siloed, antiquated technologies. And we thought, that can't be real. Is that really what happens? And so we dug in a little deeper, and yeah, it is. And so having maybe a little bit of overconfidence, but we said, it can't be that hard. Let's just go ahead and build it. And that's where I've spent the better half of 20 years of my life of what we thought wasn't going to be very hard.
Yep.
With the problem we were solving was, when I give a loan, I need to keep track of that loan, do all of the loan administration management, which includes loan servicing and collections, but I need to do it in a convenient and a compliant way. And that's been the journey that we've been on. So it was originally just an internal tool to our own lending company. And then fast forward to present day, it turned into what LoanPro is, where we sold the dealerships, we seasoned out our book of loans, and we've doubled and tripled down again and again on the software. And it turns out we started in auto loans ourselves that we sat in first chair.
Yep.
But customers sort of came to us, now customers, but they were folks who said, hey, I give loans, paraphrasing, of another flavor. And I have the same problem. Can I use your software? And I think one of the notable things, Shawn, is that we didn't come out of business school and say, hey, here's my thesis, let me build this thing. It was this like discovery process, step over step, where you discover what are the pain points, what are the needs.
Yep.
And you fill that need. And a key differentiator for today, and we didn't know it at the time, but looking in hindsight, right? Hindsight is 2020. We look at it and say that the big piece that really has been interesting is we solved a different problem. You asked what problem were you trying to solve? Well, so many of our competitors, they enter the space and say, oh, I want to provide software that manages loans. So where do you start? Of course, at the beginning. How do you give a loan? How do you source, underwrite, decide, fetch data, do a decision engine, do a pricing table, and so forth? We were solving a slightly different problem. We needed to get our money back in a compliant and convenient way. So that's a little different. We were solving ledger, calculations, compliance, tech stack, those kinds of things where you can manage, do the administration and servicing in a different way, not just origination.
Yeah, that's interesting. I mean, when we started Zest AI, 16 years ago or so, I had to pick our servicing system, and the user interface was terrible.
Yeah.
But the back end worked, and it cost us almost nothing. And our engineers would always complain to me, we should rewrite this. It's bad old code. And I'm like, you know what? The amount of money we would spend to just calculate interest correctly is more than we're spending on this software per year. Things are certainly different now than they were 20 years ago. Really clear to me that there's just no point for most lenders to try and, you don't want to innovate on the way you calculate interest. I'll say that. Like if you innovate, you got it wrong. So let's not do that. Let's focus on where we actually are differentiating.
That's right.
And it sounds like you create kind of the layer that allows folks to go spend their energies where they differentiate and hopefully spend as little time as possible thinking about your product.
Yeah, that's right. I mean, the goal ends up being that you turn into like a utility, right? That this concept where it's the infrastructure, it's reliable, it's consistent, and then you can build on top of it with the differentiators for whatever your business is, whatever your products are.
So how did you evolve the product? There was some point when you jumped from this is our thing for us and our dealerships to this is a thing that we're selling to other folks. I assume the offering, whenever you did that, isn't the same as the offering today.
Yeah.
What has that evolution been, and what were the kind of MVP, if you will, features versus what you've added over time?
Yeah, that's a great question. So I've turned into a product guy. I love product. I love the details there. So in the early days, like when this was a product internally to our own lending company with no intention of monetizing it or spinning it off into its own business, I'd literally go, I have a strong background in finance and accounting. So I'd go sit down with the developers and like tell them what we wanted. We didn't have at that point in time like a sophisticated software development process and a speccing journey. Like we didn't have any of that stuff. And so I got really into the details. Like our very first version of the software was you could only do a monthly frequency loan, payments due on the 1st and the 15th, right? Like it was really bare bones. This is 18 years ago.
Yep.
And what we ended up building over time is we had other folks come to us and say, hey, I'm doing a solar loan, or I'm doing a fix and flip hard money loan, or I'm doing a consumer loan or a merchant cash advance, or fill in the blank. And we looked at it and we said, well, what's the difference between these types of loans? And if you think about, I don't know, a spectrum, a continuum here, but let's say on one end, you have a business to business like invoice factoring or merchant cash advance or something like that, maybe a fee structure, maybe interest based, depending on timing and things. The other end of the spectrum, you have like a consumer loan that with different kinds of compliance rules and state or federal license levels and so forth. You think about that. And in the beginning, they're way different. The acquisition channel, how you acquire those loans, how you source, underwrite, decide, the customer's journey and experience, very bespoke, really niche to whatever vertical they're in. But there becomes a point in the value structure that you say, hey, those look a lot alike now.
Yep.
And that point is generally when you give them money. At the point you give them money, so the kind of the differentiation from origination to administration or servicing is they become like 70% the same. I gave you money. You have to give it back to me. Here's the rules of how it works. I got to keep track of a customer and an audit trail and a ledger and the customer comms and repayment and credit reporting and blah, blah, blah. So we looked at that and said, well, what's the delta of the remaining 30%? If they're 70% the same, what's that delta? And can we build all of those levers inside of the delta as configurable levers? And then that's how we've built it out. And so now we can support loans truly of any flavor. We have almost half of our business is the end user. The use of proceeds is B2B. And the visual I like to think of is if you're sitting in a radio station, you have all those levers in front of you and you adjust them, right? Move them up, down, whatever. And then you take a picture. The statefulness of at the time that you take the picture equals the configuration of your lending program. And then you adjust them to whatever and take another picture. That's a second program.
Yep.
And so we've spent a lot of time making sure all of the levers are configurable. And that might be something like one of our customers, for example, they do loans that focuses on teachers in the United States. And that's who's borrowing the money. And some school districts in the United States, they have teachers get diminished pay in the summer.
Yep.
And so think about this for a moment. If you're going to give somebody a personalized loan, say $20,000 loan, straight line amortized payment of whatever per month, and when you underwrite them, you know that they have diminished pay in the summer. Generally, you'll say, I have to underwrite to the low water mark. So I have to underwrite that they can only get a payment amount of X because they're going to be squoze during the summer. And that leaves some capital opportunity on the table because they actually wanted a slightly higher loan. And the reason is because the constraint of the tech stack said you had to do a straight line amortized loan.
Right.
There's no other reason. There's no real, it doesn't have to be done that way. But what if you had a dynamic or flexible system that could say, you know what, let me be aware that you need a schedule that oscillates, a schedule that will come payments down in the summer and then come back up where you have higher payment. Well, if you design a product that meets the needs of the folks that you're serving, portfolios are more performant.
Yep.
You are a better match for the customer. And we've seen exactly things like that. So our core thesis, to not belabor the point too much further, but we truly believe the future is highly personalized and finance isn't any different. The financial products will be highly personalized.
I mean, that's an interesting solution, an interesting phenomenon. There's a relatively small, I think, number of types of loans, to your point. There's basically single payment, there's installment payment, there's revolving.
Lines of credit, there's a variety of things. Generally, there's open and closed, right?
Yeah. And so creating the commonality, but I love the idea of being able to adapt within that because, I don't know, everybody's doing a straight line amortization kind of product. It's $300 a month, it's $300 a month. So if we go back to that start, you've evolved, it sounds like, in large part because you've had folks come to you and say, hey, I need this thing. Like I need a $300 payment for 9 months and $200 payment for the summer months.
Sure.
How did you originally get traction in the marketplace? I mean, I always feel like those first 2, 3, 5, 10, I don't know, you can tell me the number of customers, like are a lot harder than the next 2, 3, 5, 10.
It's a great question. And we did a series of different businesses. And so it's a slightly different answer for each business. But in the software business, we didn't have any intention of going into this business, right? It was, we truly were solving our own problem. And maybe those are the best kinds of businesses, thinking of the origin story of Slack or others, are very, very similar. They found a need, fixed it internally, and then that turned into build the businesses eventually. But in the earliest days, we were running our lending company out of the back office of our car dealerships and then building software within that space. And so we had other folks that we got to know in the ecosystem that they said, hey, this is really cool. I do loans. And one of our very first did hard money loans. They would finance real estate with an intention of flipping it within, 3 to 6 months. And they needed software to manage these different fee structures because they would have, a flat fee as well as accrual of interest. They didn't want other system that was really complicated. They wanted a really clean, but they wanted high levels of customization. So we got a lot of feedback loops that happened there. And then we had a variety of we basically in the earliest days said, all right, cool, you can use our software if you're not going to be one of our competitors. So it created this forcing function where we started getting a collection of customer sets that were specifically not in the auto lending space. That forcing function required us to learn what is common and what is not. Consequently, today, single digit percentage of our revenue comes from auto lenders. There are wide variety of different kinds of loans in the system, but that wouldn't have been if we approached it and we said, oh, we just do this certain thing and we only do that thing, then we would be much more concentrated in the auto lending space today.
Yeah.
So I think it's a process. I know that for folks listening to this, that part of the evolutionary process of knowing when is it sticking and when it is not, I think is what the question's getting at. We had organic demand. It's not like we created this and then said, I hope somebody likes it. We created it just internally, and they came out of the woodwork to say, hey, I really like that. Can I pay you money for it? For the first 2 years, we said no. We're like, no, go build your own software. It costs a ton of money. It's a ton of work, but you'll figure it out. And then after we had a few dozen consistently coming back, we thought, why not? That sounds like an interesting business. And then we made that pivot. So it was this organic swell of interest, which was not like we didn't come out of business school and this was our business plan.
Right. So how many customers did you have on the platform when you kind of decided the platform was the business instead of the dealership?
About 100 at that point in time.
Holy cow.
Yeah, so we scaled up and had about 100, and we said, hey guys, late night meeting with my two brothers. We're like, hey, we're looking at this. We make more money on the software side gig of a side gig than we do on the two primary businesses. Let's go ahead and lean in all of the way on this. And then for years, and even today, a majority of our headcount is in product and engineering. We've got about 65, 70% of our headcount is, building product. Really, really focus on that. We've scaled significantly, but we just leaned in from the earliest days of let's make sure we can differentiate on being the best product in the market.
Yeah. So how long was this overlap then from the time you maybe took on that first hard money lender to the time you decided to split these two things apart?
Probably about 3.5, 4 years.
That seems like a very rapid scaling to 100 customers.
Yeah. I always tease that it was like the earliest days were the island of misfits, right? We got all these weird kind of loans. Everyone that couldn't do something like,
right.
And so we differentiated on, hey, we can match your weird loan real well. And there was just such an organic demand because there wasn't another solution. So we were displacing things like Excel, displacing things because they didn't have another viable solution. And so they were needing, I'll give you one of our things that commonly occurred is somebody would get into the lending space and generally it was an extension of whatever their other business is, right? They would have some kind of product or service they would sell. They could learn they could sell more of that product or service if they offered some kind of credit in the same way we did at our own dealerships.
Exactly.
Right. So we did that often. So their primary gig wasn't lending. And so they didn't know everything about it, but they would all of a sudden find themselves having $1 or $2 or $10 million out in loans. And they're like, whoa, Like, I got to manage this thing. How do I keep track of it and how do I manage it? And we would meet with them and they would say, hey, I want to get a credit facility, but my credit facility requires that I'm not running these things in Excel.
Right.
You're like, oh, really? And you're like, oh, well, probably because you need to do your calculations correct. Probably because, and we had people say like, oh yeah. And they keep asking for these things. I don't know what they are. They keep asking for SOCs. Like I need to, and we're like, no, they're asking for a certification of a SOC 1 and a SOC 2. And that you can't get that when you're running on Excel.
Yeah.
And so what we found is there was these inflection points that our customers were experiencing that they needed our platform for compliance reasons, for examinations or audits, or in order to have access to a credit facility or to a partner bank. And that just sort of accelerated why, and it just spread pretty wildly with word of mouth because everyone had the same problem.
Yeah, that's interesting. I mean, we certainly run into that a lot. We've worked with companies that were managing out of Excel, Google Sheets. I think my favorite was Stripe. We're like, what's your ledger? And they're like, Stripe. And I'm like, that's
it's not a ledger.
Yeah, they may be a lot of things and it may be a great way to move money, but it's not a ledger. That's really good traction and an interesting way to approach the market. So you're building all these kind of one-offs. That feels like a great opportunity to create a horrendously complex code base.
Yeah.
So how did you avoid that in those earlier days?
It's a great question. Yeah, absolutely. And it's tempting. It's really, really attractive and tempting when the next buck on it says you got to do this special thing and then you get the buck, right?
Here's a hack.
So my CTO's been with me for, I think, 13 years now. And he's been really, really, really insistent. One code base. It is the hill we will die on because we spend a lot of time reading and looking at the history of other organizations. And when they do like an on-prem solution and then install it and then build a layer on top of it and modify it to the spot where you can't quite recognize the original solution, that's the way so many banks operate today or so many other organizations. And so when the underlying systems do a software update, they've built a whole bunch of things that are on top of it. It breaks things downstream. And we just kept seeing, hey, that's a huge problem that all of the incumbents are dealing with right now. Let's make sure we never become that. And so we spend a lot of money and a lot of time avoiding that. So I love the question. What it requires is you can't do the short-term hack of hard code something. You have to actually build dynamic program-based rules, and they're much more sophisticated, and it's a configuration-based platform. Essentially, we have three experiences. The first one's like akin to online banking where somebody can do like self-service of their loan.
Yep.
The second is the primary platform, which is where the agent would service and do the administration, managing collections on an account. And the third is the back office. And that back office is what you're alluding to, is where do you set up all of the rules of how it works? What's the guardrails? What are the controls? What are the compliance? The compliance might be with a government agency. It might be compliance with credit facility rules or program rules. And how do you set that? And we spend an incredible amount of time building that configuration based so you don't get the spaghetti bowl you were talking about of go down a road that you can never return from. And so we have never forked our code. One thing we did is interesting. As you sell into different ICPs, a different customer set, especially like a regional bank, what their concerns are is, hey, I love the concept of a SaaS, but I hate part of it too. Is generally what they look at. And you're like, okay, well, tell me more. And in that, what they mean is, I want all of the benefit of a SaaS, but I don't actually want to be sharing infrastructure with anyone else. And so what we were able to do is we were a very early adopter of AWS. We're all in on AWS microservice model. We built out a lot of services there. And on that system, what we ended up able to do is we built our infrastructure as code, where we were able to create a second AWS account. We now have many of them. And we do a VPC or a private SaaS that is the full infrastructure dedicated just to that customer. And it's a multi-tenanted anyways.
Yep.
But that's how we've been able to thread that needle of not forking our code.
So let's talk about that versus kind of the larger, more established players in the industry. Obviously, a lot of folks have been around forever.
Yep.
I mean, the problem when you're picking a loan management system or a bank partner, a lot of these things is you kind of got to get married before you date.
Yep.
And it's, leaving your loan management system it's
hard.
Nightmarish. I mean, I went through this. It took us 3 years to go from our own system at Capital One onto TSYS. Mm-hmm. Now, might not have needed to take that long, but that's what it took. So how does that play out in the marketplace kind of today? And are you mostly getting clients who are coming in fresh and don't have a system? They're migrating from Excel or they're just starting a business, or are people migrating over from other systems?
Yeah, it's a great question, and it's a nuanced answer. It depends on the verticals, of course. We certainly serve net new ideas. That's a very, low hanging fruit, straight one to do. And we do a lot of those. Probably the biggest thing we're doing right now is displacing homegrown platforms. There's a little bit of selection bias that happens in that. Just like you said, when you built your own a Cap One, the idea of why did you originally build your own, something that differentiated yourself, something that was unique. And then over time, it maybe was no longer unique. So we see a lot of things that are sort of tech forward type people. They have a unique product or a unique perspective on what they want the tech to do. And LoanPro is going to be the right solution for them to, as you started the conversation, they can build on top of us instead of spending all their time building something that doesn't differentiate them. Yeah. So we do a lot of those. So we've had to build out all kinds of interesting tools for migrations, mapping, import systems. Of course, they could do it at the API. They can do a bulk import through our platform as well. And so we've done a lot of that. And then with the banks, what we've been seeing in the vertical is what we're seeing is this trend that the traditional banking core is comprised of really three big rocks, right? A wealth management platform, a deposits platform, and a loans platform. And as I've talked to so many of the traditional core systems, they're very resilient, they're reliable, they've been around for a long time, but most of them view themselves as a deposit platform with payments attached to it, and then wealth management attached to it, and then loans attached to it. So the primary business isn't loans, that's a secondary, like an appendage to their primary business. And what we're seeing is folks are really looking for best of breed. So a little bit of breaking that apart. And our playbook is to be the very best at everything in the lane of loans and to play really nice with the others. So we've done a number of deals where they'll use a banking core for deposit platform, including some of the acquisitions that have happened in that space. And then they also choose LoanPro as the loans platform. And then we kind of stitch those together for the things that they need to do to modernize. We're seeing that trend as well. So it's a little bit of a nuanced answer. It's not a one size fits all, but we get everywhere in the jobs to be done and inflection points. We get the net new things. We get maybe you mature or grow out of your last one you had with LA Pro or a homegrown system. And then we also get, hey, let me future proof. Let me go ahead and put that tech debt and actually retire it. And let me move forward with that journey and have a strategic move. The hard part is in the industry was taught in the past that this is like a rip and replace. We don't do rip and replaces. It's a graveyard of folks out there who have done a rip and replace. Instead, our strategy has been, how do we approach to diminish the risk? How do you pull the risk way down? And a rip and replace for a highly regulated institution,
very scary,
is almost a non-starter. It's really scary. You have board approval and then everyone's freaked out because it's a really risky move to do. So we've approached this in a very a de-risk strategy of how do we do an incremental change for them that still provides the future proofing and the modernization, the loan personalization, all the compliance stuff, but in a really de-risked way. And it turns the modernization path from an event into a journey. And that's resonating really well with so many folks.
So walk me through that. That means, or let me assert, and you can tell me why I'm wrong. Does that mean I book my new loans onto LoanPro and they burn off of my old system over time? Or does that mean I'm bringing over 10% every month? And yeah, walk me through that.
There's a few migration strategies. There could be greenfield where you're doing all your net new stuff on us and you retire your old stuff. That is a strategy when we see that often, and net new product launches. It depends on the way the institution has their tech stack organized.
Yep.
You had mentioned Cap One on the card side of things. Almost everybody has their cards running, if you will, in a side core. Almost everybody runs that on the side anyways. That's a great place for us to wedge in, take over their card, and then expand over time into personal loans or SBA or the other ones as well.
Okay.
What I mean by not being just a one-time event of rip and replace, it's not that we're just coming in and saying, boom, you have to take everything. Usually what folks want is they want, give me all the staple stuff and then I want a la carte. I'm going to choose, I want this, that, or the other. I already have a 5-year contract on this piece. And so we just did a deal with a large credit union. They moved their card onto us, but they had a 10-year deal signed with a mail house service. and they had like negotiated a crazy deal on their mailers. We also have mailers that kick off in the system based off events and triggers. And what we're able to do with them to say, okay, great, that makes sense. Let's go ahead and you can keep what you want, but that doesn't have to stop you from keeping all the other stuff that you want to innovate as well.
Got it.
And that pulling apart into an a la carte really solves a lot of challenges for people on that rip and replace competition out there.
Okay, so we're grabbing parts of the system at a time rather than maybe parts of the portfolio at a time.
We can do both.
But I got you.
Obviously, you've been around a lot, so you see that it has to be unique to each organization because the things they care about are going to be different, right? Some are going to say a little bit of sunken loss fallacy. I spent $300 million doing that thing.
Right.
I'm going to keep that thing. Okay, cool.
Right.
So we do a lot of deals where a customer has think back at Zest, right? They built a really interesting origination system. Like you want to own that piece. We also have a bunch of things that could facilitate that, but you may or may not use that depending on if maybe you just want to use us for calculations or contract generation or moving money, and then the administration after you post the loan, or you can kind of pick and choose.
Okay. So if you're going to do that, you have to kind of have the cooperation. And if I'm doing the mailers, I feel like you're going to move in on my territory over time.
That's right.
Yeah. How do you get cooperation with, and how do you cooperate with companies that you're at some level competitive with?
Yeah, it's a great question. It's really a platform play. So think on how Salesforce or Slack or all these other systems that connect the dots. At its innermost ring is the concept of a platform where we're providing loan administration, loan management, loan servicing inside. We have many thousands of hours of hours in our software every week, and it's the place to deliver value to folks. And so this concept of the next ring that goes around it is solutions. And that's where you're talking about, hey, if we're going to go cannibalize a mail house service out there, why would they want to play ball with us? Well, it's because they can deliver their solution to our customers at the right time. I always tease this is selling popcorn at the movie theater, right? It's the right temperature, the right amount of butter, but it's the right person at the right time in the right place. And so you can charge a premium because you're delivering premium value to them. And so it's a matter of them participating in the ecosystem. We've been able to get our platform large enough with a number, a sizable percentage of the US population represented in our platform that we have the velocity and scale that people want to play ball in our solutions. And then the outermost ring is this concept of a marketplace that the outside world becomes discoverable to our customer set, because we can come and we can say, hey, look, you want to play ball in this place? We would love your services to extend our application. We would love for inside of the software, when an event or a trigger, a payment is made or 10 days before their birthday or before their statement date or whatever, it to physically print envelope and mail out and track it like an Amazon package. We have integrations for that. If you want to be on our integration library, great. Let's go ahead and build an integration and build a partnership with you.
Yep.
And you'll become discoverable to all of our other customer set. But we're in this together. Otherwise, if a customer wants to use you, they have to leave my ecosystem and send a file over there. And then think about when an examination or an audit comes in. An examiner comes in and they say, show me this document. They now got to leave the system and go find it somewhere over there versus it being right on screen and tracked like an Amazon package. So that enhanced value that we deliver is the way with the platform play is how we have hundreds of partners who are playing ball on this.
Got it. Okay, so let's look forward a little bit. What are the biggest challenges for LoanPro, for lenders? What's going to happen to this kind of software infrastructure over the next 5 years or so?
Oh, that's a fun question. So there's we're growing fast. If we zoom way out, we just had our revenue kickoff, RKO, that we do at the beginning of every year. Most companies do. And one of my responsibilities was come in and talk about what's the big picture? What's the thesis of the things that we think are true? And one of them is first to think that we think that the future in general is very, very personalized. Think of the difference of, a couple decades ago getting a taxi versus getting an Uber today. You're never putting that genie back in the bottle.
Right.
A taxi feels very transactional. You're never going to see that guy again. It's just getting you from point A to point B. You don't really know exactly how much it's going to cost you unless it's a fixed place like an airport run. It's not quite the experience folks are looking for versus all of the enhancements that happen with an Uber. We think financial services has that coming to it as well, where it feels like maybe some of the products of the past were, do you fit in my box? Very much like a taxi.
Oh, absolutely.
And we think that the products of the future are much more personalized, where the example that I mentioned with the teachers, we see interesting things on cards that we can do with transaction level credit. We see a high level of personalizations that folks are trying to keep their products top of mind or top of wallet. But personalization creates a couple problems because high level of personalization turns into a little bit of a challenge from a regulatory side of things and compliance. How do you stay in compliance if you now have a very long array of boxes instead of one box? And so we've spent a huge amount of time and energy unlocking that possibility of how do you keep your programs organized and how do you keep them compliant? And as the rules adjust, how do you make sure you stay compliant with that? We think that there's a huge push on personalization, and the compliance tied to that is a big area of our focus. And if you think of, we got a big game coming up, and if you think of our field position, if the future is more regulation and compliance, so think of the Trump administration, it appears that they're going to be pushing things down to the states. Well, what does that look like? It looks like 50 countries.
Yeah.
And so it's a checkerboard of compliance that you have to thread that needle. And even from one administration to the next administration, if you go back even decades, the underpinnings of what the objectives and the goals are, they stay the same, right? We want the safety and soundness of the US financial economy and that whole ecosystem. But the methods that are gone about to try to do that are pretty different. And so it feels like a yo-yo effect of like the rules adjusting back and forth. And so we've been really intentional that we think the rules will keep changing. And so can we build our tech stack in a way that can evolve and support an evolving rule set to keep the accounts compliant instead of just assuming that the rules are written in stone?
Yeah.
And so I think that's a big, what we see in the next number of years is an evolutionary process on what financial products look like, becoming much more personalized, but also the compliance that goes around that piece is a big area of focus. We'll continue to serve our three markets, right? Private credit. In that space, the future I think the numbers are from 2023. I haven't personally seen, I don't know if they're out yet for the numbers for 24, but roughly a third of all loans in the United States were given in private credit in 2023.
Yep.
So my view is if you're in charge of the Fed and a third of the loans are given to something that you're kind of blind on, you see those pieces in the rearview mirror, it seems logical to me that as a third turns into 50%, that they're just going to change the rules a little bit and give non-depository institutions of a certain size will have reporting requirements that look a lot like the reporting and governance requirements of FIs. And so having a platform like ours that serves both markets, I think will be really important. We think that comes in the next 3 to 5 years as that trends forward. We see banks file a report called a call report. Over 80% have publicly announced that one of their top 3 initiatives is modernizing their tech stack. So we see a huge momentum happening on that side.
Yeah.
And then on our third vertical of cards, we've seen the last decades had some pretty cool stuff on the acquiring side of cards, right? That piece and that side of it's done some really interesting things. Think of, stuff Stripe's done. Think of point of sale stuff with Toast and Bread. Like there's some pretty cool stuff that's occurred on that side. Block's done interesting things. But on the other side of the house, on the issuing side of cards, there's not been a huge amount of innovation. Most of the innovation's about a decade old. It's like, can you do a virtual card? Can you put it in your phone? Can you button that card down to only be permission to be used at certain places? And those are really all card attribution. A big unlock we're providing is we're in the auth path on the card issuing side, and we're the ledger to manage the card issuing. And so that provides some new tools of something we have patented called transaction level credit. The idea that when you go swipe your card, you can have very unique things happen with that swipe. And the way that we do it is the card that's in most people's pocket is like, there's 3 buckets: a purchase, a cash advance, and balance transfer. You know this better than most. The idea is use attribution from that transaction to route it to the appropriate bucket. But instead of being constrained to 3 buckets, I can have N number of buckets, and I can use any rule-based logic to route. So one of the examples that we've done is for like US military. We had a credit union come to us and say, hey, I'm the credit union for military members, but I've got a problem. When the service member goes active duty, I drop being top of wallet. Why? And so we went and talked to a ton of their folks, and it was a fairly, Dunning-Kruger effects, comes back to simple, is basically they didn't feel like the credit union got them. It was an inflection point. Generally, the relationship transferred to their spouse, and they were like, well, I don't know, I'm going to use the one I've always used. Why would I keep using this card? And so to solve that, we said, well, you have to have the family feel like you are the personalized credit product for them. You've got them. You understand the experience that they're having. You've done this a whole bunch of times. This is their first rodeo. like make it easy on them.
Right.
And so to do that, we said, let's do this. How do you make them feel you got them? Anything you could imagine in a rewards program, pull that forward into the financial instrument itself. So let's say, hey, family, let's geofence your primary residence, do like a 10-mile radius around home. And any groceries you buy during deployment, 0% interest on the grocery transactions because we got you. We understand you. We want to take care of your family. We want to keep you connected with your loved one. So your Sprint or your T-Mobile bill, we're going to treat that a different way and so forth. They picked like 7 different things. That's the level of personalization that you can unlock when you're managing the ledger. And it still fits within the card is the access point to the line. So your question, what's the next 3 to 5 years? Once the genie comes out of the bottle of personalized credit, just like an Uber, you're never putting it back in. And we're seeing a lot of momentum in those spaces.
Yeah, that's really interesting. Going back to the start of that, I think if I understood you correctly, it's almost like, so you've parameterized the product, and now we need to really parameterize the regulatory side of it,
That's right.
The compliance side, because we're not monolithic potentially anymore. And even to the extent we're monolithic, we've seen pretty big swings from administration to administration in terms of how they want to implement.
On that last one, what's interesting is in the run up to the last administration leaving, the CFPB was printing these things like boom, 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 right? They're flying out daily, sometimes multiple per day. But if you look in the last 6 months, there's a number of these that have come out that if they require the implementation period they give for them, if they require a technology like code change, their implementation period is less than the release cycles of many systems out there.
Yeah.
So you just think about that for a moment. The government comes out and says the rules change to do ABC. And in order to do ABC, your technology needs to do some kind of an update. And they physically cannot do that in the time that's required.
Yeah.
That's why we think modernization is being pushed from every level. And we're seeing the acceleration of that occur from a regulatory side, from boards are pushing it. Everybody is pushing this modernization to occur.
It's a really interesting concept. I hadn't thought about how much more volatile, so to speak, that has gotten and how much more volatile it will get if you have 50 states regulating kind of the way you do. You see that on installment and auto loans, things like that already.
You do.
But a lot of products have managed to escape that. All right. So last question. So last season we had on a woman who started a business with her husband. You started with your 2 brothers, I think you said?
Yeah.
How many brothers do you have?
I'm the youngest of 8 kids.
All right.
Big family.
So a little awkward for the other 5, I suppose, who were left out of the business.
No. They've all done some very cool things.
So what has that been like? What are the pluses and minuses of starting with siblings?
Oh, we've had a wonderful time together, have great partnership, still have a very, very strong partnership. It's worked out great. So in the earliest days, we didn't have 2 nickels to rub together. And it's sure nice to have a friend in those days, right? Very, very helpful. And, the way that we looked at it is when you win as a partnership, you're like, woohoo, I get all the upside, right? And when you lose, losing can be kind of lonely. And so it's really nice to have a true partner on that. And we've done all of our businesses together. My 2 brothers that we did a sequence of these businesses, they've stepped out of day-to-day operations at LoanPro, and the size of our partnership has expanded. We started a public charity called Become More, heavily involved on that side. We also started some investments to do in family office. And so I'm busy running things here at LoanPro, where other brothers are busy doing that. We also have another brother that didn't do the sequence of businesses with us, but he's the president of the charity. He actually got his PhD in economics. He was a professor. And when we started the charity, he came and chose to run that. And so we're pretty jazzed about the opportunities to work together and, love my brothers. Have wonderful experiences together. We've had so much fun together. I hear often people ask me like family business. I don't know. Can you do that? And the reality is it's the only thing we've ever done and we've loved it. It's been great. The fun parts in the earlier days with your 2 brothers, like if you have a disagreement, I don't know, you just punch each other and then you get over it and you move on. So there was never like a risk of like, if you have a conflict that it's like the end of a relationship, right? That was like never on the table. It's not an option. My brothers are super smart. They're super passionate and done very well in so many areas. And so we've loved our partnership. I wouldn't do it any other way, but I do hear folks feel like, hey, that would be kind of weird with family. And it's what we've done our whole life. And even like early business, like young kid mowing lawns, it was always together in the unit of our family.
That's awesome. Yeah, certainly you read in the news, there's families that get pulled apart by it. I don't know, it's luck or something that holds it together, but that's really great to hear. Well, thanks again for joining. I think it was really interesting to hear about kind of the evolution of your business from rock-dense chips out of Windows to a loan management software. So thanks for spending the time.
Yeah.
All right. Well, thanks again. You can follow EnsembleX, LoanPro, and Rhett Roberts on LinkedIn. You can also visit us at EnsembleX.com. You can find the EnsembleX Exchange podcast on all major platforms. Thank you for listening. And once again, thank you, Rhett, for joining me today.
Thanks, Shawn. Appreciate it.